What is up, everybody? This is Ryan with TrendLizard.com, and I'm here to drop some more Elliott Wave knowledge on you, and specifically to answer one question. That is, what the heck are these weirdo Elliott Wave people talking about when they talk about corrective or counter trend moves in an Elliott Wave pattern? I got some good news for you. This is the definitive guide to corrective moves in an Elliott Wave pattern. We're going to tell you what they are, when they should begin, what we expect from them and how long they should last, and where they should end. We're also going to take a look at the different types of corrective movements that are possible in an Elliott Wave pattern. We got a lot to look at, so get comfortable, and here we go. All right, folks, so to bring you the definitive guide of corrective moves in an Elliott Wave pattern, we have to start at the very beginning, and that is, what are they? What is a corrective move? So according to Elliott Wave theory, there's only two types of possible price action. Every single thing that happens on a price chart, whether you're looking at the S&P 500 like we're looking at here, or a stock or an ETF or a mutual fund, falls into one of two categories. It's either trendy price action or corrective price action. And corrective price action is counter-trend price action. It's action that moves against the direction of the trend. So in this example here, this is the trend. The trend is playing out to the upside, and the counter-trend action is the action that goes against the trend to the downside, as shown in yellow here. This is counter-trend or corrective action. So there's a few things you need to know about corrective moves just out of the start. One is that, generally speaking, you don't want to trade corrective moves. The moves that you want to trade are the ones that are trendy, something like this. Obviously, you can make a lot more money when something is going up like this. Obviously, that's the goal of trading. You want to buy at a low price and watch it head higher and then sell it for a higher price, and then the thing you own is worth more. Now, when you look at a corrective move like this, it's going against the trend. If you were to draw a straight line across it, it would hit that line several times along the way. It's pretty hard to buy something low and sell it high when things are moving against the trend because it's not moving up. So that's the main thing. The next thing you need to know is that most counter trend moves play out in three waves. You can see here's the first wave. We call these wave A. Call that wave A. The next move, the second move, is wave B to the upside, and then the third move, wave C, to the downside. So that's a three-wave move. Most of them play out in three waves, and I'm going to show you every single type of corrective move that's possible so you can have a little bit more in-depth knowledge about that, but understanding that they are generally three-wave moves and that they are the other type of price action that is not trendy is a good starting point. The next thing you want to ask is, when do these moves begin? So I'll tell you very specifically, these moves begin when trendy moves complete. And what do we know about trendy moves? Trendy moves play out in five waves, like you can see here in black. This is the first, second, third, fourth, and fifth wave. Once this completes, you get that corrective move. So that is when you're expecting them. Along the way, as you're playing out in a five-wave move, you also have corrective moves within the trendy pattern. So once you complete this first wave here, you get a corrective move to the downside here. When you complete this trendy move here, you get another corrective move here. So second waves and fourth waves within the trendy pattern are also corrective moves. Obviously, they're on a smaller time frame than something like this, but this is also when corrective moves happen. But it follows the same logic. So this corrective move happens after this five-wave advance completes. This corrective move here that played out in 1989 and 1990 happened after this five-wave move, this 1, 2, 3, 4, and 5, shown in blue, completed. This is when the corrective move happens. Then you get another five-wave move here, and you get another corrective move. Then you get the completion of the entire five-wave move, and you get the larger correction. So every correction that's happening is just correcting the five-wave advance that preceded it. So it's just, this pullback here was just correcting this five-wave move. This fourth wave pullback here was just correcting this five-wave move here, this third wave advance, which is it's in itself a five-wave move. So that's when you're looking for corrective moves. The next thing to ask is, what do we expect from a counter trend move or a corrective move? How long should it last? When should it end? What should it do? So let's go ahead and address that. Again, when they begin is at the completion of a five-wave move on any time frame. What we expect this move to do is basically correct, just like it sounds, this five-wave advance. Obviously, things don't move in a straight line. That's just not how the stock market works. There's ebbs and flows, and this part, in my mind, is the ebb. I might have that backwards, but you get the gist. It basically is correcting the strength that is played out previous to the correction, just to basically refuel and get ready for the next big trendy move. And if you follow the stock market, you know what happened after this three-wave pullback completed in 2009. The market went ballistic to the upside and resumed the trend from there. So how long do we expect a correction to last? And again, when you're talking about corrections, you're talking about just a correction of the preceding five-wave move that happened just before the correction started. Generally speaking, you expect a correction to last anywhere from, say, I'd say in a very general term, you would say about 50% of the time to 100% of the time that the preceding trendy move lasted. So this move here took 17 years to play out. So the counter trend pullback that followed it actually took about 9 years to play out. So that was a little bit more than 50% of the time that it took to play out here. That's what we're looking for in terms of time. A lot of people live and die by trying to time these things out when it should happen in a certain time window. I'm not a huge believer in that. I think what's more important is the depth of the correction that you're looking at. So let me delve into that a little bit more here. This is what we're looking for in terms of the magnitude of the corrections, how deep the correction should move before the trend resumes. What I do is I look at the entire points that were traversed over the trendy move, and then I look at what would be a 38.2% retracement of that entire up leg, and also a 61.8% retracement of that entire up leg. We expect the low for that pullback to happen somewhere in this retracement box, basically. And I highlight them, I make them yellow on my charts and at my website at TrendLizard.com. But that is basically all we're looking for. We're looking for the counter trend pullback to find support and find a low somewhere between a 38.2% retracement and a 61.8% retracement of the preceding advance, the five-wave advance that it is correcting specifically. Now, another aspect of where we expect it to end, other than somewhere in this retracement area, is we expect the end of the pullback to occur at a new low for the pullback. This is normally true. It's not always true, but I'd say at least 85-90% of the time that is true. So you can see the initial low to wave A, the first move of this corrective pullback, happened here around 800, and then you had the C wave low, the ultimate low for the corrective move, move to a new low, and that's normally a pretty good sign that you're getting closer to a low, especially when you're still within that yellow support area like this low was that happened back in 2009. Now, if it doesn't move to a new low, it's what we call a truncation, and those are fairly confusing. That's when the ultimate low to the pullback actually happens at a higher level than the low that, say, happened for wave A. So those are possible, but again, they're more rare. Maybe again about 10 to 15% of the time you will get a truncation, and the move doesn't have to set a new low before giving way to a resumption of the uptrend. So here's another chart that gives you an idea of when corrections happen, just in a general sense. Obviously, when this five-wave advance completed for Micron Technology in 2018, you knew a correction was coming. You knew that a correction of this entire five-wave advance was going to begin, and then you begin analyzing the corrective move itself, as I'll show you how to do momentarily. But the yellow area here shows you the corrective move, and then also these small yellow boxes here show you other corrective moves that happened within the five-wave advance. And again, those happen in the second and fourth wave positions within a five-wave advance. The trendy moves, the easy moves, the ones that are easy to make money with, are obviously the first, the third, and the fifth wave advance. Those moves are going to play out in sharp, strong, trendy fashion, and they themselves will be five-wave moves. It's the corrective moves that separate each five-wave move. So again, when a five-wave move completes, all you're looking for it to do, for the correction to do, is to correct that five-wave move that preceded it. So for this first of a third wave here, you're looking for this second wave pullback to just correct this up leg here. So that's important when you're determining how big the pullback should be. You know the magnitude should be similar to what happened in the preceding five-wave advance that completed it. So when you get the completed five-wave advance, obviously that is when you're going to get the largest corrective moves that move against the trend. And I can't stress enough that these just aren't the moves that you want to trade. If you're trying to buy here and trade this little up leg, it's a losing battle. It's a much stronger and smarter approach to just try to stay away from the corrective moves, analyze them, determine when they're going to end, and then when they do, that is your buying opportunity. So that is what a correction is. And again, if you're not in a trend, you're in a counter trend movement at all times. There's no price action that doesn't fall into one of those two categories. It's either a trendy move, and that's the stuff you want to trade, or it's in a corrective or counter trend move. So the next question that we need to address is what type of corrective moves are possible. So when this big correction plays out, or any of these smaller corrections play out, you want to have a general idea of what form they might take, how might they play out. It gives you a good idea of when it's going to end. Also, obviously you're looking at the retracement zones and the time factors and things like that, but also a very important part of it is the actual price action and the form it takes, so you know when it's going to complete and when the trend is going to resume. So let's go through all the different types of corrective moves that are possible within an Elliott Wave pattern. So the first one here is a flat correction. So as you can see, it takes the general three-wave form that Elliott Wave corrections normally take. You can see wave A to the downside here in red. Wave B moves in the direction of the trend but is still part of the corrective move here, and then the C wave down completes the move. As you can see, it moved to a new low. So here's the specifics about a flat correction. It plays out in what we call a 3-3-5 formation. So wave A, the first down wave, plays out in three waves internally. So if you look, this whole thing here down to April's low is wave A. If you look at the internals of wave A, it's a three-wave move, A, B, and C, as shown in red. Wave B to the upside is also a three-wave move, A, B, and C. Now the C wave, and this is almost always the case, plays out in 5 waves. So it looks like a trendy move, but it's actually the ending move to the corrective pattern. This ends the pullback, and there's a purpose to this when you're thinking about how Elliott Wave works and how it plays on social mood. A sharp down move that happens like this really scares the heck out of people. This is February 2019. We just had a brutal decline in December. When that move happened, that was a C wave. If you looked at the headlines at that time, the mainstream media was talking about how the end was here, how the bear market was back, how everything was, kind of the end times and things like that. That is because C waves, these ending waves, are designed to do that. They're intended to scare the heck out of people because they're quick, they feel trendy, they're very sharp, they move to a new low. So during this move, you see you get a low here, and then you get a lower high. This is below this high, and then you get a lower low. So this is, for a lot of people, the sign that things are a lot of trouble is ahead. And that's exactly why it works, because when everybody starts thinking one thing, that's when the market reverses and heads the other way. So again, this is a flat correction. This is 3 waves down, 3 waves up, and 5 waves down. That makes a flat correction. The thing that can really determine when you're looking at a flat correction is that it's largely flat. It largely moves sideways. I mean, this is a long time. This is the entire 2018 year here on a financial ETF. It moves sideways forever. There's no confusing this with trendy action. It's not sharp. It's not moving to the upside. It's moving against the trend, and it is very corrective stuff, and that is the stuff of flat corrections. The next type of common corrective pattern that you'll see out there is what we call a zigzag. Now, zigzags are a lot sharper than flat corrections. Like I said, flat corrections tend to move sideways. Zigzags tend to move more sharply against the trend. Now, their internal structure is 5-3-5. So if you look at wave A here to the downside shown in red, you see it's a 1-2-3-4-5 move. So that looks like a trendy move. So these are scary moves. These make people wonder if the trend has actually changed. From there, you get a B wave up, which is a 3-wave move, A, B, and C. And then you get a C wave down, which is again a 5-wave move. So its structure is a 5, 3, and 5. Obviously, the thing that determines that this is not a trend is that the overall structure is a 3-wave move, A, B, and C. So anytime you see a 3-wave move on a price chart, you know that it's a counter trend corrective move. It is not a new trend. It is just correcting the old trend and getting ready for the resumption of the trend from there. And you can see that happen here on this ETF. Once the C wave ended at a new low, nice ending pattern, price reversed upward, and then you had yourself a nice trendy advance, and that actually kicked off the resumption of the trend for this ETF. So the next type that we're going to look at is a triangle pattern. This is the third type of corrective move that we're looking at here. The determining factor for a triangle pattern is that it is a sideways contracting pattern, and it actually plays out in 5 waves. There's no mistaking this as a 5-wave trendy move because it moves sideways, while trendy 5-wave moves move in the direction of the trend. They're strong, they're purposeful, there's not a ton of overlap. And by overlap, again, I mean if you draw a straight line across the price action, it would hit it several times. It would continually hit that line over and over. So with a triangle pattern, the third type of corrective pattern we're looking at, it plays out in a 3, 3, 3, 3, 3. So you get 5 3-wave moves that again contract, and you can see that play out here. ABC for the first, ABC for wave B, ABC, ABC, ABC. So there is your triangle pattern. So the most common types of counter trend or corrective patterns within the Elliott wave pattern are either flat corrections, zigzags, or triangles. These are the 3 main types. I would say flats and zigzags are the most common. Triangles come at a distant third, but they are still fairly common. You'll see them a decent amount. A thing to know about triangle patterns is that these never play out as a second wave. They only play out as either a 4th wave or as the B wave of a larger correction. So if you're looking at a pattern and you think you see a triangle and it's in the 2nd wave position, you're wrong. The correction is not over yet. Triangles do not play out in as second waves. Why that is, I don't know. That's just a rule of the Elliott wave theory, and it's one to pay attention. So let's take a look at a couple more confusing or complex type corrective patterns that are possible. So this correction here is what we call a running correction. Generally speaking, running corrections will be flat corrections. If you recall, flat corrections play 3 waves out in the initial A wave, 3 waves up to the upside in the B wave, and then 5 waves down, so a 3, 3, 5. The thing that makes this a running correction is that the high for the B wave, the up portion of the corrective move, actually moves above the high that was recorded for the trend itself. Now the way you determine that this is still part of a corrective pattern and not the resumption of the uptrend is that that B wave or that up leg that happens in the middle is a 3-wave move. It's not a trendy 5-wave move. So that's how you can sniff out that a correction is still playing out, and we have a pretty real example that happened in 2018 for the stock market as a whole. Even though the high for the trend occurred in early 2018, we saw several months where the market moved higher, actually moved to a new high. A lot of people were calling it the resumption of the uptrend, but it was not. It was not trendy movement. So if the return of strength comes and it's not trendy, then you know that you're still in the corrective move. So once this B wave completed above the previous trend's high, price reversed back down, it'll give you that ending 5-wave decline, and then the ultimate low for the counter trend or corrective pullback happens above the low that occurred in wave A. So you can see the whole thing is kind of slanted upwards here, and that's what makes it a running correction. It kind of moves in the direction of the trend, but it's still a corrective counter trend move that is ultimately going against the trend and getting the market ready to resume its advance. So there's a running correction. Next up is an expanded correction. An expanded correction is very similar to a running correction, except it expands out in both directions. So here's the high to the trend here. You have your A wave down here, and then you have your B wave advance. It moves to a new high above the trend's high, and then when it reverses back down in the C wave, that ending C wave decline, it actually moves to a new low. So again, you have a higher high here, and you also have a lower low. That makes it an expanded correction. The next type of corrective pattern that you will run into as you're analyzing these corrective moves is what we call a double correction. So essentially any of the previous corrective patterns that we're talking about get together and they play out side by side. So you get this correction here, you get this nice ABC, it's kind of an extended flat correction here that played out. But Cisco wasn't ready to resume its uptrend. So what you get is you get kind of a separating wave here which I call an X wave. A lot of people call it an X wave, not just me. And then you get another 3-wave pullback, another correction here. This one's more of a zigzag. So you get a flat, you get something connecting the two, an X wave, and then you get another correction. So this is a double correction. Out there, when you're doing your Elliott Wave research, you might find people label this W, X, and Y. That's confusing to me. I don't need to bring in any more of the alphabet. To me, it's an ABC, X, ABC. So that is a double correction that you have to watch out for. And the trick here to know that this didn't end the counter trend pullback is that, again, the recovery portion here was not trendy. You can see it's a very clear 3-wave move. So anytime you're in a correction and price starts turning upward towards in the direction of the overall trend again, you need to analyze that move to determine if it itself is trendy. If it's not, it means the correction is not yet over. So I've got one more for us to look at here. This is a super complex, super ugly chart here. This is what we call a triple correction, and it's the same idea as the previous chart, the double correction, except you actually get 3 corrective moves that play out back to back to back. Again, you get a nice 3-wave move to the downside here, then you get this X wave, and you can see this was not trendy action. That was not the resumption of the uptrend. AMD was not ready to resume its uptrend, so it continued to chop around in corrective fashion. You get the second ABC here, and again, you get an X wave. Still wasn't ready to resume. You get a third ABC pullback. So these are really confusing, super hard to scroll out in real time. It's normally just something that you realize is happening after it's over. But again, the key is when that move ends, seeing trendy action follow. So once you get this corrective, the end to this corrective move here, what you're getting is trendy, strong, purposeful action, 5-wave moves, and then you know that the correction has ended. So the question you might be asking is, how do we know what type of correction is going to play out after a trendy 5-wave advance completes? And the real answer is you really don't know. There is an Elliott Wave rule, if you look deep into the book, that they expect alternation. And by that I mean, say the second wave is a zigzag, then you might expect the 4th wave to be a flat. You never expect a 4th wave and a second wave to be the same type of correction. But other than that, you really don't know. All you know is that a larger correction's underway, and frankly, that's what makes it so difficult. There's only one type of trendy pattern. It's a 5-wave advance. Counter trend patterns, there's all kinds of different ways they can play out. That's one of the many reasons why it's just not a good idea to trade them, because you just don't know what's coming. So bottom line, the purpose here is to understand that there's several different ways that it can play out, but basically you just don't want to be involved. You want to analyze it, try to figure out what type of corrective pattern is playing out. More importantly, just to figure out when it's going to end so you can get back to the good times when the trendy action resumes. So that, folks, is pretty much everything you need to know about corrective moves. So the things to keep in mind, to take away kind of the too long didn't read version of this, is that once a trend completes, once a 5-wave move completes, that is when you expect the start of a corrective move. Now, generally speaking, corrective moves play out in 3 waves. As you could see from the types of corrective waves, there are different options. You can get a 5-wave corrective move if you're looking at a triangle, or all kinds of different combinations when you're looking at more complex corrections. But as long as you keep in mind that these are not moves you want to trade, and they're more just for you to analyze to figure out when they're going to end, you're going to be okay. Now, again, the key is to find when they're going to end, ideally in the retracement zone, somewhere between a 38.2% retracement and a 61.8% retracement of the immediately following trendy move. That's a good idea for when the low is going to occur, but the most important thing is to see the resumption of trendy price action. So for those of you who want to be heroes and want to try to buy exactly when a low occurs, it's a bad idea. You need to see trendy action to the upside to know that a corrective move has ended and that the trend has resumed, and then it's lights out. Time to start buying and make some dough. So I hope that's helpful, folks. This is Ryan with TrendLizard.com. I'm going to keep pumping out new Elliott Wave videos for you to make sure your Elliott Wave game is shipshape. Please subscribe to this channel. I'm working hard trying to get good information out there, and we'll go from there. So have a great night. I will talk to you again very soon. Take care.